This chart represents one of the most powerful investments in history, the S&P 500. For decades, it made investors rich, but now, for the first time in years, people are asking, is America still the best place to invest? For many years, one investment has stood above the rest. It has been the king of the castle for investors around the world. This investment is known by its ticker symbol, SPY. It represents the 500 largest companies in the United States. For decades, putting your money into SPY has been a winning strategy. It felt simple. It felt safe. The returns were strong. The story was easy to understand. You were betting on the success of the American economy, and that bet paid off handsomely for a very long time. It became the default choice for millions, a cornerstone of retirement accounts and investment portfolios everywhere. The idea was straightforward. America was the center of the global economy. Its companies were the most innovative and powerful. By owning a piece of these companies, you were hitching your wagon to a powerful engine of growth. This simple idea created immense wealth for patient investors. The S&P 500 became a symbol of prosperity. People watched its daily movements on the news. Its performance was often treated as a report card for the entire economy. But the world of investing is never static. Today, we stand at an interesting crossroads. So, what is this thing called SPY? The letters stand for the SPDR S&P 500 ETF Trust. That sounds complicated, but the idea behind it is very simple. Think of it as a big basket. Inside this basket, you will find small pieces of 500 companies, the largest and most important in the United States. When you buy one share of SPY, you are not buying just one company. You are instantly buying a tiny slice of all 500 of them at once. It is the oldest and most well-known exchange-traded fund in the world. It began trading in 1993. The companies inside this basket are names you know and use every single day. Think about the phone in your pocket, the software on your computer. When you buy something online or search for information, these giants live inside the SPY basket. It also includes other household names in healthcare and banking. The beauty of SPY is its simplicity and diversification. Instead of trying to pick the next winner, you just buy the whole group. This spreads your risk out. If one company has a bad year, it is balanced by the other 499. Diversification is one of the most important rules for successful long-term investing. SPY makes broad U.S. exposure easy without being an expert stock picker. SPY is not a stock in the traditional sense. It is a fund that holds a collection of stocks. It trades like a stock, so you can buy and sell throughout the day. Its price moves based on the combined performance of all 500 companies. When you hear the market is up, it often refers to the S&P 500, the index SPY tracks. It is the benchmark most pros measure against and the starting point for understanding the market. Why has SPY been such a dominant force for so long? You can boil it down to 3 pillars. These pillars work together to create a powerful engine for growth. Understanding these strengths explains why so many put their faith and money into the U.S. market. Pillar 1. The relentless engine of innovation. New products, new services, entirely new industries. Over 30 years, the internet, the smartphone, cloud computing, and artificial intelligence. U.S. companies became the largest and most profitable, anchoring SPY. A handful of leaders now make up a huge portion of the index. They didn't just improve old ideas, they created new markets and changed how we live, work, and communicate. Profits soared, prices followed. This is supported by world-class universities, a legal system protecting IP, and a finance machine funding bold ideas. A pipeline of dynamic companies refreshes the S&P 500. While others focused on banks, resources, or old manufacturing, the U.S. focused on the future. Profits funded more innovation, a self-reinforcing cycle of growth. Pillar 2, a magnet for global capital. Pillar 3, a deep, dynamic economy that lets businesses thrive. Innovation attracted capital, which funded more innovation, which created more wealth, attracting even more capital. SPY's performance is no accident. It stems from these fundamentals. U.S. companies outcompeted, out-innovated, and outgrew global peers. This success made SPY the world's benchmark. But the very sources of strength could also seed future challenges. Next, the magnet for global capital, and where cracks may appear. The second pillar supporting SPY's incredible run is U.S. safe haven status. When uncertainty rises elsewhere, capital seeks safety. The U.S. dollar is the reserve currency. Treasuries are considered safest. That perception extends to U.S. stocks. From Europe to Asia and beyond, investors have poured trillions into U.S. markets, with SPY a key beneficiary. Inflow acts like a steady tailwind, boosting demand and prices. Beyond individuals, massive pensions, sovereign wealth funds, and global corporations choose the U.S. because it's deep, liquid, and transparent. Liquidity means big trades with minimal price impact. Transparency means clear rules and available financials. Safety attracts money. Performance validates safety. More money comes in. Lower cost of capital fuels projects. Growth. Profitability. A unique advantage. Higher potential growth abroad often comes with higher perceived risk. Politics. Currency swings. The U.S. has offered growth and relative safety. Rare and powerful. SPY is held worldwide, a truly global core. Next, the cracks appearing in the crown. For all its strength, SPY's crown shows cracks. No investment goes up in a straight line forever. 3 concerns stand out. Not to panic, but to prepare. First, valuation. Second, concentration. Third, slower growth. These risks are interconnected. High valuations stem from incredible past growth. Success concentrated returns in a handful of giants. The larger they are, the harder it is to grow as fast. Recency bias tempts us to expect the past decade to repeat. History suggests high valuation eras often mean lower future returns. Not a crash call, just tempered expectations. Valuation matters. A wonderful asset bought too dear lowers future returns. S&P PE is well above its long-term average and higher than many foreign markets. High multiples bake in high expectations. Merely meeting them can mean flat prices. High valuations don't predict crashes, but suggest lower medium-term returns. It lowers your margin of safety, paying premium prices for premium companies. A key reason to look abroad for better value today. While the U.S. faces high value and concentration, the world looks different. Years of underperformance have left many markets cheaper, less crowded, and poised for growth. Young populations, rising consumption, rapid expansion. China has challenges, but Asia's broader story remains powerful. World-class companies are emerging across sectors. Friendshoring creates new jobs and growth in rising hubs. Reforms and sector leadership at lower valuations than the U.S. Room for earnings growth and multiple expansion. Limiting to one country risks missing compelling stories. So, what should an investor do? Balance, not abandon. Maintain a significant low-cost U.S. core like SPY, still the largest innovative economy. For many U.S. investors, 50 to 60% in the U.S. can anchor the portfolio. Add a broad developed world fund, diversified exposure beyond America. Consider a smaller emerging market sleeve to capture higher growth regions. Focus on the long term. Don't chase short-term performance. Some years the U.S. leads, other years international wins. Diversification aims to build resilience across environments. Set targets and rebalance yearly. A disciplined sell high, buy low mechanism. Own the world, not just one corner of it. The S&P 500, represented by SPY, has earned its crown, built on innovation, global capital, and a dynamic economy. But 2026 differs from years past. High valuations and heavy concentration imply more modest returns. Meanwhile, the world isn't standing still. A global shift is underway. Keep SPY as your core, but don't let it be the whole portfolio. Balance is the path. Make your portfolio reflect the global economy. Add international and emerging exposure. Because the next wave of wealth won't belong to one country, it will belong to the world.